Thanks for pressing play. This is the Pirate Street Journal. 3 topics from business, tech, enterprise software, and the consumer, all through a category design lens. 10 minutes per topic, 30 minutes total. I'm Bree Clark. With me is Eddie Yoon and Christopher Lochhead. Hey ho, let's go. Today's first topic is Mag 7 earnings and B2B tech. Our second topic is what the B2C consumer, GLPs, and protein all have in common. And our third topic is the AI wars, SpaceX AI versus Anthropic, and the Neo Cloud pivot. Welcome to the first ever Pirate Street Journal. Topic 1, Mag 7. 7 companies that are basically the US stock market right now all reported earnings this quarter recently, and every single one of them printed bullish. NVIDIA's up, Azure's up, AWS had its fastest quarter, all between 40 and 73% raised. Microsoft is on track to double its global data center footprint in 2 years. Anthropic just hit a $30 billion run rate. Half the financial press is calling a bubble. The other half is calling it the biggest infrastructure build out since the railroads. And the numbers don't care really what side you're on. So, Christopher, pirate, non-obvious lens. In one sentence, are we in the early innings of a category we'll talk about for a decade, or the late innings of a bubble we'll laugh about in 5 years?
We are in the early innings of the greatest innovation category ever created. Point A. Point B, are we in a bubble? Well, I'm no stock expert, but if you look at where we are vis-a-vis market caps and particularly multiples on earnings or growth, look, are the Mag 7 high? Sure. Are they bubble-like? Does this feel anything like 1999? Well, I'll tell you, I was there in 1999. I was part of it. I don't think so. However, it doesn't matter unless you're looking at how to make money in the stock markets. We're not talking about that right now. What does matter is we are in the first inning. We haven't even seen the rise of agents at scale yet. And so we're absolutely in the very beginning. And even though I believe that to be true, according to David Sachs, the AI czar for the country, AI in the last quarter drove approximately 75% of GDP growth. And so what do we know? It's the greatest new category of innovation in human history, arguably since the wheel. And I think we're in the very first innings. And if you take AI out, America is in a lot of trouble economically, socially, and politically. When you have AI in, we're winning. We're winning the tech battle, tech stack, and we're getting the benefit of all of this incredible growth.
Well, I'll jump in, Christopher, and say, we're not stock market experts, but I am watching the stock market. And what is interesting is NVIDIA, has had the crown for the world's most valuable company for, a little bit of years now. And what is kind of crazy is I've never seen this before. So number one, Jensen is gangster. He has 60 direct reports, runs his shop the way that he does. And he is the master of meets, beats, and raises. And so Wall Street loves that from that perspective, right? He's an amazing CEO, a lot less crazy of Elon and stuff, right? So you have that going. And then what appears to be the case is that when the Mag 7 reported on that one day that a bunch was kind of going out, the consistent number that they said was our expectations for CapEx going up, which can only mean one thing, is that NVIDIA, with effectively a monopoly on GPUs, their demand for the revenue is going up. And my understanding is that all they are is capacity constrained. And so you have a phenomenon where NVIDIA had a huge print. The rest of the Mag 7 said, we had a great print and we need more CapEx, of which NVIDIA is going to be the beneficiary of. And the part that I think, to your point, Bree, about the bubble aspect of it, the only argument that I can see is that, well, wait a minute, NVIDIA is the world's largest company by value. How can it possibly go higher? And that, to me, is a stupid argument. Just because it's never been done before doesn't mean that it can't be done. And that, if you look at the history of the world and the US GDP, it's kind of just gone up and to the right. And that in as much as population has slowed down, I don't see any end, to your point, Christopher, about the demand for AI going away. If not, it's super early in that. And it does seem like everyone has figured out, hey, it's game on, the race is on. And to your point, it's not like they are spending out of capital on the balance sheet. They're spending out of cash flow of some of the world's most cash flowy I don't know if that's a phrase. Some of the world's most cash flowy generative businesses that we've ever seen, like Google, you could argue is the perfect business model. It's a platform and they just print money. And they're just taking all that cash and deploying it into the AI cycle and the hardware, of which NVIDIA is going to benefit from, of which everybody else is going to go. It does seem like it's early innings. And it's the premise that Wall Street is rejecting is that it's not been done before, therefore it can't be done. I don't know. From a pirate perspective, I don't think that's a very good reason to say it.
People with that point of view aren't paying attention. First of all, it's important to understand, and the fact that more people don't is interesting. So here's the sort of category design lens on stocks, if you will. And again, not advice. At the highest level, it's oversimplification, but at the highest level, there's two kinds of investors. There's investors who invest in current performance and investors who invest in future potential. And yes, there's some in between. However, when you look at GE's earnings or Ford's earnings, a typical S&P 500 company, for the most part, those companies are valued on their current performance. They have a good quarter, their margins improve, their revenue growth improves, their stock's going to go up, and it's going to trade within a well-known multiple of earnings and or revenue. Potential companies are very different. The reason Tesla is worth what it's worth is because people think there is this thing called category potential. That's why Anthropic is the most valuable company in the world, not because of what they've done, although what they've done is incredible. But what they've done as it relates to driving their valuation or market cap is prove that there's massive potential in front of them. And so this is something a lot of people miss, right? What's driving the market caps is investors' belief in the category potential of AI. The other thing I'd say is we're operating in a world that's not actually the Mag 7, it's the Mag 9. Just two of them aren't public yet, right? OpenAI and Anthropic. And one thing that's lost on a lot of people, to go back to your original question, Bree, is OpenAI created the fastest growing category and became the fastest growing startup in the history of startups. And then two people, a brother and a sister from OpenAI, left and created Anthropic. Now Anthropic is the largest and fastest growing company ever. And so you've essentially got two, let's just call them emerging Mag 7s in, some people would argue the same category. I'd argue there's an important difference, consumer versus enterprise, consumer versus developer, but we don't have to go into all that right now. The point being, not only are we in the early innings of AI, but the Mag 7 is going to be the Mag 9 very soon here. And two of those companies are the most powerful pure play AI companies ever created.
100%. And I think to your point, the Mag 7 has driven over the last X years, the vast majority of the stock market gains, and that the rest of the companies have not really done much with it. And I think to your point, it's probably just getting bigger. The large language models are being added. SpaceX is looking to go public in June, give or take.
Yep.
We know the markets go risk on and risk off. And as these kind of hotly anticipated private companies look to go public, it's not like there's a shortage of unicorns and decacorns like Stripe and whatnot that back in the day would have gone public a long time ago, but for whatever reason, they haven't.
They've effectively done private IPOs is what's happened.
Yes, that's the new category of, to your point, enterprise value capture with it. I do think it is notable that, it's a tech thing. The part about AI that's interesting is it is in fact both an enterprise and a consumer thing. I mean, it's not always the case that it is both. I think about back in the day, in the original .com bubble, Christopher, like what Cisco was kind of doing, obviously in the hardware to kind of get the broadband out, like consumers wanted that. It was much more of a B2B play. And we know that the consumer is, call it 2/3 or 70% of the market, and B2B, a critically important part. And so when you have AI kind of running on two core engines of the market, that all sounds like good news. And it sounds like I got hit with some sort of a warning track from Bree.
That was a warning track. You still have 30 more seconds for final thoughts.
Okay, I got one quick one. Can they continue to grow? 100 years ago, global GDP was, best guess, either one of you, global GDP in 1926 was $3 trillion. $3 trillion. So global GDP 100 years ago was $3 trillion. Today, 126 trillion. That's between a 40 and 50% or 40 and 50 time, 50x increase in just 100 years. So to your point earlier, Eddie, what people don't understand is legendary entrepreneurs, legendary category designers create new value from nothing. And we're talking about a 50x, a 50x improvement in value creation across the planet in 100 years. So could they continue to go up? Absolutely.
Quick break, pirates. Everything Pirate Eddie just said about the consumer, he's been saying things like that for 20 years across Procter & Gamble, McKinsey, Harvard Business Review, and now Category Pirates. Everything Pirate Christopher just said about category design, he literally wrote the book on it. 3-time public company CMO, co-author of Play Bigger, the guy Silver Lake calls when they need to make sense of the future. Now imagine both brains on demand for your business, your career, your next decision. That's the Pirate Eddie bot and the Pirate Christopher bot, trained on every Category Pirates mini book ever written, every super consumer framework, every creator capitalist take, and every category design playbook. You ask, they answer, in their voice with their lens. They come with the founding tier on Substack, alongside the full mini book library, the audiobook library, digital copies of all 7 of our big books, and every Scooby snack we drop. You can find it at categorypirates.news/subscribe. Now let's get back into the next topic. All right, topic 2, the consumer. Eli Lilly did several billion in one quarter on 2 drugs recently, Mounjaro and Zepbound. 15% of U.S. households are now on GLP-1s. Those households cut their grocery spending by an average of 5%.
Hold on, Bree. What percentage?
We are currently at
15.
15%.
15% of America is on a fat loss shot.
Yes.
All right.
And those
Sorry,
households,
keep going. That's a big number.
Yep, cut their grocery spending by an average of 5%, 8% for higher income households. Meanwhile, cottage cheese sales seem to be up 20%. RTD protein drinks went from 6 billion category to a 7.6 billion category in approximately 2 years. Starbucks just launched a protein cold foam, posted its best quarter in years, and even the US food pyramid almost doubled its protein recommendation. And in the middle of all of that, Chipotle, the company that should be winning on the protein trend, just reporting that their earnings are down. Younger consumers are visiting less, they have smaller orders, they're scrambling to launch the right high protein menu item to save the quarter right now. So, Eddie, these are all super consumers. Are GLPs, high protein, and the Chipotle problem 3 separate stories, or are they all the same story?
It's a bit of both, Brie. What's kind of fascinating is there's a few truths that are going on. One is that the consumer market was, and always will be composed of 3 different types of consumers. There are proactive consumers, there are reactive consumers, and there are inactive consumers. It's just kind of the way that it is, right? And that whether it is Thigh Master or whatever the special exercise trend or nutrition trend of the year, it's usually the proactive, about 10% of the population, the reactive, about 20% of the population, and the inactive tends to be about 70%. That, the inactive are like, whatever, I'm just going to keep watching and snacking away. The reactive kind of go to the trend after trend, and then it doesn't stick. But the 10% actually get outcomes. And so what is kind of fascinating about this one is you have that same phenomenon, and that's just kind of the way that consumers segment in the market in the US and beyond. And then the second thing that is also true is that in the food and beverage industry, it's at a much, much slower pace than technology. But people forget that back in the day, Campbell's soup, 100 years ago, was a technology marvel. They had solved for food safety. So, Christopher, you talked about GDP, was $3 trillion 100 years ago. Back in the day, what you worried about when you ate was you would die from bugs, E. coli that we know now, because we didn't have refrigeration, wasn't as mainstream, preservation wasn't as good, and that when Campbell's first came out with canned goods, they were ahead of pasteurization. They were leading the world from a technology standpoint about like, hey, we have figured out a way to put food into the cans, and at high heat and high pressure, it kills all the bugs, and you can eat that can of food X days later, X months later, X years later, and you'll be safe. What the consumer market has long forgotten is that at their core, if you look at everything that we have, and Christopher, you wrote about Bird's Eye in Play Bigger, right? Was a massive technology transformation that enabled them to make a new leap forward. So that's what's different about this time. There will always be proactive, reactive, and inactive consumers. And that you see that 15% are on GLP-1s. Those are largely the proactive and some reactive folks that are there, right? However, This is probably the first true technology step forward that I have seen in my 30-year CPG career here. And the nature of these drugs is that they inhibit desire to some degree. When you mute desire, there's a lot of unintended consequences that come with it we'll get into. But what it effectively does, it is going to change the ratio of proactive, reactive, and inactive consumers. Because there are some reactive consumers that would like to be proactive, but they can't. So in a world where 10, 20, 70 becomes 25, 25, 50 maybe, that's a game changer. And I
Yep.
do think what you're going to see is that people will buy less of the conventional foods because they're going to realize that, wait a minute, if I get real technology steps forward from these drugs, why am I buying this stuff that is like, because a 100-calorie pack is not a technology revolution. That's smoke and mirrors. That's lying with the truth. And that there's a lot of that in CPG that just needs to stop.
So while you were talking, I just did a little bit of research, Eduardo, and get this. 71% of Americans, according to Amazon, are trying to consume more protein, and that's in 2024, up 67% from 2023 and 59% from 2022. And that's 2024 data. Obviously, it's 2026 now. And then, interestingly enough, 61% of Americans increased their protein intake in 2024. Those megatrends appear to be continuing. And so, what happens in the B2C world, Eddie, when there's this mega trend that's happening, which is a move to more protein and a move to GPL1s, which I assume are adjacent and somewhat
Yeah.
connected,
Yeah.
right?
Yeah.
It seems like a massive amount of B2C providers, particularly in food and in wellness, have been caught flat-footed by this.
100%. And that what you're going to find is we're talking about category violence in a couple of mega categories. So food and beverage is one. You have pharma with Eli Lilly is another, right? And they're the beneficiaries of it. And then you have the fitness industry. Our buddy Carl Dakeler at Body, they're going to benefit from this. And then you have a lot of the folks that I would put in the mercenary category versus the missionary category. Starbucks claims to be a coffee company. They're a milkshake company. It is something that they know inherently. Protein cold foam is a bunch of BS. Cold foam is real. That's a legit category. But it's like, if you're going to sell effectively milkshakes and ice cream, call it milkshakes and ice cream. Don't try to lie your way through it with the protein part of it. But to your point, Christopher, when you take the GLP-1s, if you do not exercise, you will lose muscle as part of the weight loss, right? And therefore, the protein is a way of mitigating the muscle loss that's there. What I think is going to definitely happen is that you look at the next phase of GLPs, which will not be injection, will be pills. That's going to be a game changer because there's always going to be some segment of the market that's like, I don't like needles and the like, right? And pills have much higher compliance. So
I've started to see ads for GLP-1 pills.
oh yeah. And so pills, the prices are going to come down. Pills.
Are there going to be, sorry to interrupt you, Eddie, are there going to be GLP-1 drinks and GLP-1 rubs or scrubs for your butt and nose?
GLP-1 dude wipes?
Yeah, exactly. GLP-1 dude wipes so it can come up through the bottom. Like we're at a point now where protein, where it's like everything has added protein. It seems like more protein, more protein. And we got to get to a point of like, we're going to have these products that are like protein with GLP-1s already mixed in.
I have no doubt that the supplement industry, which again has a lot of lying with the truth and some fraud going on there, that there will be these GLP-1 like things that are coming out. So buyer beware. But I think the part that you're highlighting is in this kind of category map of pharma, food and beverage, fitness, healthcare, your Sherpa does not really exist. The closest thing is probably a nutritionist, but they don't carry the same weight as an MD. The MD has all the credentials, but has no real intellectual capital about how to keep you healthy proactively. They can help you if you're sick, but they don't know how to help you lose weight. I mean, they're going to tell you eat less and watch your sugar intake and blah, which is not helpful. This is where I think AI is going to pop in because the population in the B2C space that has always been the most forward leaning on nutrition and fitness and all this kind of stuff are bodybuilders and athletes. They are the ones who are willing to experiment on themselves and therefore have the most credibility. Like our old, co-founder Pirate Cole, right? He was a skinny, a teenager, a self-proclaimed loser back in high school and was like, I want to get girls. So he started lifting and eating, boiled chicken 5 times a day. And then he got huge and jacked. And then he wrote a book called Skinny to Shredded. And that was his first major book that went bonkers and stuff, and therefore launches his writing career.
There's also, I love that story, and we sure miss Pirate Cole. There's another mega thing going on here that I want to bounce off you on, just validating the numbers, right? So in the US today, healthcare is just a hair under 20% of GDP. And it's growing, and Americans are getting sicker and older and fatter and less young, right? The wellness category, which is the, am I done here?
Yeah,
The wellness.
You have 1 minute.
Okay. Wellness category is 38% of the healthcare category. And so another thing that's going on here is there is a new mega category emerging that straddles healthcare, wellness, and fitness. I don't know what people are going to call it. For a placeholder, we can call it the whole body or the whole human category. But if we were to draw a Venn diagram of all of the markets that are converging, the fundamental aha is this: is a patient is a consumer, and a consumer is a patient, and a consumer and a patient are a person. And that's one and the same thing. And people are focused on longevity, people focused on well-being. And so it's a very interesting time, I think, in the consumer space, because all of these things are colliding around answering a question called, how do I live a more healthy, longer, more satisfying life?
You're going to get the prosumer, which I would argue is somebody who is a consumer but is that much further along, who has outcomes. When Cole got jacked, he was a prosumer. Joe Rogan is probably the ultimate prosumer of like, hey, man, I'm in shape and I'm the master of my own domain and destiny and all that kind of stuff. And that what is interesting is when you have these prosumers powered by AI, it'll be way easier for people to find them. And so I go back to AI, one of the early use cases was as your counselor. It's going to be as your fitness coach. It's going to be as your nutritionist. And probably the easiest compliance is, hey, I just took photos of what I ate and I uploaded it to Claude and tell me what to do, what not to do with it.
Absolutely. Most people don't realize, today we call mental health behavioral health. And AI with ChatGPT in the lead, best to my knowledge, is the number one behavioral health provider in the world. And
Plus,
so now we have a scenario where everybody has an AI doctor in their pocket, an AI nutritionist in their pocket,
and an AI shopper, because you'll unload your groceries, take a photo of it, and say, what should I buy more of? What should I buy less of? And so I think unless these CPG companies get proactive and not reactive, they're going to get caught flat-footed.
Yesterday, I saw a demo created by a technical wizard where what he's created is a series of agents that track his travel, and it knows what he likes to eat. And it tells him where to eat while he's traveling. It goes out and looks at the menu. It calculates the amount of calories, and it recommends to him what to eat before he gets to the restaurant. I saw that demo yesterday.
All right, topic 3, third and final. This one, the Wall Street Journal covered, though I'm not sure they fully captured how wild it is. So quick recap. 3 years ago, Elon Musk launched xAI to beat OpenAI and Anthropic on the frontier model game. The company raised capital at valuations approaching $250 billion. He built Colossus One in Memphis, which is roughly 220,000 NVIDIA GPUs, drawing around 300 megawatts. xAI burned heavily in 2025 with capex and operating losses in the multi-billion-dollar range. He produced Grok, which has been growing but still trails significantly in revenue and enterprise adoption compared to rivals. Meanwhile, Anthropic, one of the companies he set out to beat, has scaled to roughly $30 billion analyzed revenue run rate. And then last week on May 6th, Elon folded xAI into SpaceX, dissolving it as a standalone company and creating SpaceX AI. In the same move, they leased the entire Colossus One data center to Anthropic, all 220,000 GPUs. It's a multi-billion-dollar per year deal that gives Anthropic massive dedicated capacity. Brad Gerstner and others have already started calling arrangements like this the Elon Web Services, and the guy who set out to beat Anthropic just became one of its biggest compute landlords. And in the process, the high margin lease revenue helps make SpaceX cash flow positive right before its expected IPO next month. So, Eddie, is this the most expensive surrender in tech history or the smartest pivot of Elon's career? And what does that tell us about who's actually winning the AI war?
Well, if you read the biography on Elon by Walter Isaacson, I think what the story's in there is that what people will describe is don't play poker with Elon. not because he's an amazing poker player, but effectively his strategy is to go all in on every pot. And if he busts, he doubles down, goes all in again, and he does it until he wins. And then when he wins the pot, then he quits. Basically, is what they talk about. And it's a strategy that works if you have the biggest chip stack to begin with. And therefore, what you have here is the wealthiest man in the world, and therefore the biggest chip stack in the world, willing to double down. And to your point, the XAI Colossus story, it's just kind of mind-boggling because we all remember this goes back to when he bid on Twitter, kind of as a joke, to buy it for $44 billion, give or take, tried to back out of it and was forced by the Delaware judge to buy it. So, he went and bought it. And then, everyone is kind of like, hey, this is the biggest debacle of your career. And then, enterprise value went down, and people were like, oh, haha, look at, he fell on his face. And then the AI race becomes, and then he starts XAI, merges XAI with X, formerly Twitter. And now those folks are, in the green and in the black now. He's building out Grok, and as you said, Bree, behind the times of everybody else. And then, you have OpenAI and Anthropic going like this. And then turns out, the Colossus data center, that's him going all in again. Oops, I lost the hand. Let me keep going all in again until I win. And here he goes, and he just pulled the rabbit out of a hat again in a way that is a win-win because the enemy of my enemy is my friend, apparently, right? So he's cuddled up with Dario, even though he had some misgivings about it beforehand. So I think what it's telling me, Christopher, and I'd be curious about your thought, is that in as much as LLMs are an amazing innovation, in as much as the GPU is an amazing innovation, in as much as all of these things, the Neo Cloud, AWS, Google Cloud Services, whatever, it is the company design lever of the magic triangle that might be the most important part. Because here's what I am a little bit nervous and suspicious about is that we were all in on Lucy on ChatGPT, and then now we're kind of like, Lucy, stay. It's that meme, right? The kids drowning, and then we're holding up Claude now, and then I have no
Well, and going back and forth, right?
going back and
When
forth.
I'm vibe creating with AI for a certain kind of thing, based on how we've trained our
Yes.
models, I'll
And
start with our ChatGPT model because there's something about that model that I know executes in a particular way, at least the way ours has been trained. And the same thing is true with Anthropic Claude. I will often go back and forth and massage back and forth, validate data, et cetera. And so the reality is the models themselves are going to be, some people are saying commoditized. I don't think that's true. Over time, maybe, but I don't think we're anywhere close to commodity models yet, even though there are good open source models. But that said, I think what we're finding is that different models are better at different things, particularly the way we've trained those models. So not necessarily the generic publicly facing models. And the second thing I think we've all learned is that while there's tremendous power in having, let's just call it a universal LLM, if you're going to be doing specific domain area work or application development, having a small LLM that is purpose built or focused on that can be tremendously valuable. There's some interesting things going on here, though, however, that I wanted to make sure that we all understood. The two biggest constraints in AI are GPU, access to power, access to compute power, and access to power. Most people don't realize what the tech companies are doing to get their hands on electricity. Microsoft did, I believe it's a 10-year deal, we can double check, to revive 3 Mile Island, the nuclear plant that blew up and freaked everybody out. That's how much power is in demand. The reality of what we need here is more compute and more power to power that compute. That, it's such an amazing thing to think about. That is holding back growth of AI companies in spite of how incredibly fast they are growing. According to carboncredits.com, in the US, data centers are projected to account for nearly half of all power demand through 2030. So this is all about getting access to power and all about, therefore, getting access to compute.
100%. Well, and I think to your point, Christopher, that access to power, access to compute, a lot of it is the other sides of the magic triangle, right? How you design the company and how you design the category. Because part of how Elon was able to stand up Colossus in the first place was he called Jensen. He's like, "Hey man,
Figured out a way to get
cut to the foot of the line." Yes,
exactly. The other thing that people, if we go back to Elon for a second, most of what you need to learn, Bree, you can learn in Spinal Tap. One of the lines in Spinal Tap is there's a fine line between stupid and clever. It's playing out right now. And I think betting against Elon is going to show itself to be stupid yet again. So Elon understood this. Elon understood that if you're Dario at Anthropic, before Anthropic existed, your biggest barrier to success was ability to scale, not create demand. Once the category got formed, demand exploded for all the obvious reasons. There's an interesting thing going on here. Elon forward invested in hard infrastructure. Elon knows how to build giant plants, giant factories, stand up massive. I mean, they're called Colossus for a reason, right? And so what that means is if you put it in the context of XAI, his competitor ChatGPT and Anthropic, et cetera, he is the only AI platform with theoretically, and I'll put it in air quotes, unlimited access to compute and power because he pre-built it. This Anthropic deal that he just did, this frenemy deal that he just did with Anthropic, where Anthropic is getting this preferential access to his compute, shows how forward-leaning and how right Elon was, because he's got his own, if you will, integrated stack from a consumer-facing AI and all the technology supporting it, all the way through to the data center, all the way through to energy with all of his solar businesses and beyond. And so what we're seeing here is a very smart person who invested way ahead of the curve in CapEx to drive, in hard asset CapEx, to drive growth in this area. And essentially what we've got here, if you think about what Anthropic on Elon's Colossus platform could be, it's like if a ChatGPT and AWS merged or did a giant deal, right? That's what you have now. So he's got quote unquote unlimited compute, and he's now done a deal with Dario at Anthropic to give them almost the same advantage. I'm sure they don't have every advantage that he does. And it's genius.
And it's the right risk position to take, because one of the key things that I thought about, Christopher, was I had done some work for Keurig way back in the day and they had about 6 million households in their platform. And every incremental, before I get to that, the retailers were pissed at them because they were always out of K-cups. And you have out of stock, a shopper shows up to XYZ store and their favorite K-cup's not there. What's going to happen? They're going to go to another store. So they were pissed about this. And they were annoyed with the Keurig folks, like, hey, get me the K-cups. Now the K-cup management was like, well, shoot, the CapEx for a line, it's $5 million and it takes 9 months to build out. What should we do here, right? And so that's what I was brought in to say, is 6 million the ceiling? Is it 7? Is it more than that? And so when I came back and said, I think it's closer to 36, they were like, really? I'm like, yeah. And they're like, are you sure? I'm like, well, kind of. I am sure about the trajectory, not as sure about the timing, right? I'm sure about the trajectory and I'm sure about the slope of the line, which is to say, you got 6 million, you got 36. There is an S curve in there. No one can be right on timing perfectly. None of us here are Nostradamus. However, if you're going to be wrong on the right side of the S curve. If you're on the good side of the S curve, be aggressive. If you're on the bad side of the S curve, be slow. And that's where they leaned and they were aggressive there, and it paid off massively for them. And Elon understands, because this is the whole point of the whole topics that we talked about, whether it's AI and the Mag 7, GLP-1s and protein, and SpaceX and our XAI here. As far as we can all tell, we are on the right side of the S curve. And therefore, if you're going to be wrong, you should be wrong aggressive and not wrong passive.
Exactly. And it's so funny you said this. So I'll leave it here, which is, if you think about it through the category design lens and you think about the decisions to build out, let's just call it the AI ecosystem infrastructure. Let's just call it that for lack of a better term. Here's the seminal question. And it's a seminal question that everybody looks at when looking at massive new growth potential in a category, which is the risk of staying the same greater than the change? And if that's true, if the risk of staying the same is greater than the change, then what there is to do is go all in on the change. And that's what's happened over the last 5 or so years in Silicon Valley. The leadership has just said, oh my God, this thing is indicating massive and we're going to go massive. And here's the interesting part about that. It creates a self-fulfilling prophecy.
All right. And that's the Pirate Street Journal, the non-obvious from the obvious. If this gave you something to chew on, do us a favor and give us 5 stars wherever you're listening. And if you want to keep the conversation going, head to categorypirates.news/subscribe and become a founding subscriber. You get the Pirate Eddie bot and the Pirate Christopher bot, so you can jam on your business and your career with us anytime.